Swing Trading. Chapter 9, Moving Average Crossovers and Strategies. Moving averages matter because they smooth out the day-to-day noise that can make a chart hard to read. Instead of reacting to every sharp up day and down day, they help you see whether price is generally improving or generally weakening over time. A crossover happens when a faster average and a slower average switch positions, and that can be an early clue that momentum is changing. For swing traders, that matters because many trades are built around catching a developing move that may last for days, weeks, or even longer. The keyword is clue. A crossover does not predict the future, but it does tell you the balance between short-term and longer-term price behavior may be shifting. Two of the most widely watched crossover signals are the golden cross and the death cross. On a daily chart, they usually refer to the 50-day simple moving average crossing the 200-day simple moving average. A golden cross happens when the 50-day moves above the 200-day, suggesting buying pressure has improved enough to lift the intermediate trend above the longer-term trend. A death cross is the opposite, with the 50-day moving below the 200-day, which points to increasing weakness. Because so many traders watch these signals, they often shape how people frame the bigger trend. Even so, they should be treated as evidence, not certainty. For swing traders, these signals are useful mainly because they speak to medium-term trend change rather than very short-term momentum. On a daily chart, the 50-day and 200-day averages move slowly, so the crossover usually appears after the turn has already begun. That delay can feel frustrating if you want the earliest possible entry, but it also filters out a lot of minor price noise. In practice, this makes the signal more relevant for moves that may last weeks or months, not quick 2-day bursts. It helps separate meaningful trend shifts from ordinary daily chop. So the trade-off is simple: less speed, but often better context. Spotting the signal is straightforward. Start with a daily chart and add the 50-day simple moving average and the 200-day simple moving average. The 50-day gives you a read on the intermediate trend, while the 200-day reflects the longer-term trend. Then watch for the point where those two lines meet and cross. That moment is not automatically a buy or sell signal by itself. It is better thought of as an alert telling you to investigate the chart more carefully. A crossover becomes more convincing when price action agrees with it. After a golden cross, stronger charts often show price staying above both moving averages, with pullbacks finding support rather than collapsing back under them. After a death cross, the opposite tends to happen, with price staying below the averages and rallies failing near them. The slope of the averages also matters. Rising slopes after a bullish crossover, or falling slopes after a bearish one, suggest the message is gaining strength. If price quickly turns sideways and reverses around the averages, the crossover is much less reliable. This is where discipline becomes important. A crossover is usually more useful as trend context than as an immediate command to act. Buying the instant a golden cross appears can lead to chasing an extended move, and selling the instant a death cross appears can be just as careless. A better approach is to let price prove the shift through a pullback, a bounce, or a failed rally. In other words, the crossover tells you what kind of environment may be developing, and price action tells you whether that environment is actually tradable. That small difference can improve timing and reduce unnecessary trades. Once you are in a trade, many swing traders stop relying on the crossover itself for exit timing. The 50-day and 200-day averages are so slow that waiting for the next opposite crossover can give back a large part of the move. Instead, traders often watch whether price continues to respect the 50-day average and whether the chart keeps forming healthy swing highs and swing lows. If that structure starts to break, the trade may be weakening even though the larger crossover has not changed yet. This is why exits are often based on price behavior rather than on a later moving average signal. The practical goal is to protect gains before the market fully rolls over. Imagine a stock that has been falling for a long time and then begins to stabilize near $50. It stops making lower lows, buyers begin returning, and the 50-day moving average gradually flattens instead of pointing sharply down. Eventually, the 50-day closes at $52.10, while the 200-day sits at $51.80, creating a golden cross. That sounds bullish, but a patient swing trader might still wait. If price later pulls back and holds above the 50-day average, that bounce can offer a more controlled entry with clearer risk. In that example, the pullback is often more useful than the crossover day itself. This kind of signal deserves caution when the market is not trending clearly. Sideways conditions often produce crossovers that look important but fail to follow through. It also helps to check the broader market because an individual stock may struggle if the larger environment is weak. Another common mistake is expecting quick results from a slow signal. A 50-day and 200-day crossover is not designed for instant acceleration. It is designed to confirm a broader shift. The highest quality reads come when the crossover, price action, slope, and nearby support or resistance all point in the same direction. A good way to build skill with this signal is to study follow-through, rather than just the crossover itself. Open a daily chart of SPY with the 50-day and 200-day simple moving averages and find one golden cross and one death cross. Then check where price was about 30 trading days later. Was price clearly higher or lower, or did it just drift sideways? Pay attention to the slope of the averages, whether price stayed above or below them, and whether the move actually continued. That kind of review teaches you which crossovers had real trend support and which ones were just noise. After looking at slower, long-term crossovers, it helps to shift to a much faster pair. The 9 and 21 exponential moving averages are popular because they react faster to recent price changes than simple moving averages do. The 9 EMA hubs price more closely, while the 21 EMA smooths things out enough to act as a short-term trend filter. That combination gives swing traders a way to spot momentum shifts without dropping all the way down into very noisy intraday tactics. In many cases, this setup is used for trades that last a few days to maybe 2 weeks. So compared with the 50 and 200 setup, this one is more about timing short swings than confirming big trend changes. The basic signal is simple. A bullish crossover happens when the 9 EMA rises above the 21 EMA, suggesting recent price strength is overtaking the slower short-term trend. A bearish crossover happens when the 9 EMA drops below the 21 EMA, suggesting momentum is fading or turning lower. Because these averages are short, the signals appear more often than the 50 and 200 crossover signals. That can be helpful when a stock is trending cleanly, but it also means you will see more low-quality signals in messy conditions. So the crossover is best viewed as a possible momentum shift, not proof of a lasting move. A simple bullish process keeps this strategy from becoming random. Start by applying the 9 EMA and 21 EMA to a daily chart. Then wait for the 9 EMA to close above the 21 EMA, rather than jumping in mid-candle while the lines are still shifting. After that, look for price to be above both EMAs, because that adds confirmation that the market is actually acting strong. Many traders then enter on the next candle after confirmation. The idea is not to be first at any cost, but to be consistent and selective. Once you are in the trade, the 2 EMAs can help you judge whether the short-term uptrend is still healthy. A common approach is to place a stop below the 21 EMA or below a recent swing low if that gives the trade more realistic room. As long as the 9 EMA stays above the 21 EMA and price keeps respecting the structure, the bullish case remains intact. If the stop gets hit, or if a bearish crossover appears, the trade may be telling you momentum has changed. This creates a clear framework for both staying with the move and knowing when to get out. Short-term systems work best when risk rules are just as clear as entry rules. The same structure can be flipped for bearish trades. In a short setup, the 9 EMA crosses below the 21 EMA, and ideally price is already trading below both averages. That alignment suggests the recent momentum and the broader short-term trend are both pointing down. A trader may enter after confirmation rather than on the exact crossing moment. Then place a stop above the 21 EMA or above a recent swing high. If price reclaims the averages or the EMAs recross upward, the setup may be failing. The logic is exactly the mirror image of the long trade. This 9 and 21 combination is popular because it balances speed and structure. The 9 EMA is fast enough to catch early momentum shifts, while the 21 EMA is slow enough to keep every tiny wiggle from looking important. That gives traders a simple framework for entry, exit, and trend assessment all in one setup. It is especially attractive for people who want a repeatable method rather than a highly subjective one. But its strength shows up most clearly when the market is already moving with some direction. In strong trends, The pair can help you stay aligned with momentum without overcomplicating the chart. The weakness of this setup is the same thing that makes it attractive: sensitivity. Because the averages react quickly, they can flip back and forth in sideways markets and create repeated false signals, often called whipsaws. This gets even worse on very short time frames where noise can dominate the chart. A crossover that looks exciting on a small chart may only be a brief bounce inside a larger downtrend or a pause inside a range. That is why trend context matters so much. Before acting, it helps to ask whether the bigger picture supports the signal or undermines it. A worked example makes the process more concrete. Suppose the 9 EMA is at $50.20, the 21 EMA is at $49.80, and price closes at $50.50 above both averages. That gives you a bullish crossover with confirming price position. A trader buys the next day at $50.50 and sets a stop at $49.70, risking 80 cents per share. The trade continues higher until a later bearish crossover triggers an exit at $52.50. That produces about $2 per share, or roughly a 4% move, while the EMAs define the whole trade from entry to exit. Most mistakes with this method come from treating every crossover as high quality. Traders often get into trouble by taking signals in choppy markets, using 1-minute or 5-minute charts, or entering before the crossover has actually completed at the close. Another major problem is skipping the stop loss because the setup feels simple or familiar. It is also easy to ignore the structure around the signal, such as whether price is above both averages in an uptrend or below both in a downtrend. The better trades usually come when the crossover matches the trend, the candle closes confirm it, and risk is planned before entry. Without those filters, the method can become a machine for overtrading. A useful practice routine is to review recent bullish crossovers on one stock or ETF you follow regularly. Find the last 3 bullish 9 and 21 EMA crossovers, then measure how far price moved before the next bearish crossover appeared. Check whether price stayed above both EMAs during the move and whether the trade lasted more than just a couple of days. You can also compare what happened during trending periods versus sideways periods. That gives you a feel for where the setup has real edge and where it becomes unreliable. The point of the exercise is to study follow-through, not just the crossing itself. The main takeaway is that the 9 and 21 EMA crossover is a clean short-term swing method built around momentum shifts. It becomes stronger when price is also above both EMAs in a bullish setup, or below both in a bearish one. It is most useful for swings that last days to a couple of weeks rather than for very long-term trend analysis. Like most fast signals, it weakens quickly in choppy markets, where follow-through is poor. So the crossover can be a strong tool, but only when paired with confirmation, context, and disciplined risk control. Stepping back to a longer view, the 50 and 200 simple moving average crossover is watched because it compares the intermediate trend with the long-term trend. The 50-period average reflects what price has been doing over the last several weeks, while the 200-period average speaks to the broader direction over many months. On daily charts, this is one of the most widely recognized moving average combinations in the market. Its main value is not catching the very first turn. Its real value is helping traders confirm whether a larger bullish or bearish trend is taking shape. That makes it more about perspective than speed. The signal comes from the relationship between those two averages. When the 50 SMA is above the 200 SMA, it suggests the intermediate trend is stronger than the longer-term trend was in the past, which points to improving conditions. When the 50 SMA is below the 200 SMA, it suggests deterioration and weaker trend strength. The actual crossing events have familiar names: Golden Cross when the 50 rises above the 200, and Death Cross when it falls below. These labels are widely used, but the concept is simple. You are watching whether the shorter trend is gaining enough strength to overtake the longer one or losing enough strength to fall beneath it. It is important to keep expectations realistic with this signal. Both moving averages are based on past prices, so the crossover is a lagging indicator by definition. That means a meaningful move often begins before the cross appears on the chart. In other words, the crossover usually confirms a trend rather than announces it at the earliest possible moment. This is why it is not ideal for exact entry timing. It can tell you conditions have improved or weakened, but it does not cause the trend, and it does not guarantee follow-through. A golden cross usually develops in stages rather than all at once. Price often begins below both moving averages during the earlier part of the recovery. Then the 50-day SMA turns up first because it reacts faster to improving prices. As the recovery continues, the 50-day eventually crosses above the 200-day and completes the signal. When price is also holding above the 200-day average, that adds support to the bullish case. So the crossover is often the middle of the story, not the beginning. A death cross forms through the same kind of process in reverse. Price and momentum usually weaken over time rather than collapsing all at once. The 50-day SMA rolls over first as recent prices soften, and if weakness continues long enough, it eventually drops below the 200-day SMA. That crossing suggests longer-term conditions have deteriorated enough to show up in both averages. For traders, the message is usually not panic. It is a warning that the broader trend has become less favorable, and risk may need to be managed more carefully. Consider an example like Apple moving from 180 in late June to 220 by early September. In late June, price is still below the long-term averages, with the 50-day at 185 and the 200-day at 185, and the 200-day at 185, and the 200-day at 190. By early September, price has already rallied strongly, and only then do the averages catch up enough for the 50-day, now at 195, to move above the 200-day at 195. To move above the 200-day at 195. The key lesson is that the crossover appears after a large part of the move has already happened. So the signal is not saying, this rally is beginning. It is saying, this rally is this rally has matured enough to be recognized as a stronger trend. After a crossover appears, the next step is to check whether other evidence supports it. Is price actually holding above the 200-day average in a bullish case or below it in a bearish one? Are higher highs and higher lows in place, or is the structure still messy? It also helps to see whether the broader market is trending in the same direction, because alignment improves the odds of follow-through. Volume can add another layer of confirmation if stronger participation appears during the move. The crossover gets more meaningful when it fits into a healthy chart, not when it stands alone. This signal tends to work best when the market is already trending in a smooth, persistent way. In those environments, price structure usually supports the direction of the crossover, and the broader market often agrees. A bullish setup is more convincing when price continues to respect the 200-day average during pullbacks instead of slicing back through it. That behavior shows the longer-term trend is acting as support rather than just sitting on the chart. The crossover then becomes part of a consistent directional story. In a strong market, that can help traders stay aligned with the bigger move. False signals become more common when price is choppy and trendless. In sideways markets, the stock may move above and below the moving averages repeatedly without building a durable trend in either direction. That creates whipsaw behavior, where a crossover appears important but quickly loses meaning. It is also possible for a stock to look one way while the broader market looks another, which further reduces reliability. This is why standalone buy or sell decisions based only on the crossover often disappoint. The more sideways the market, the less useful the cross becomes as a directional tool. Used properly, the 50 and 200 crossover helps you align with the bigger trend instead of chasing noise. The common mistakes are using it too early, using it for very short-term trades, or treating a death cross as proof that a crash must follow. None of those interpretations is what the signal is designed for. Its practical use is long-term confirmation, especially when combined with price structure, support, volume, and the broader market trend. Think of it as a lens for seeing context, not as a fast trigger. When you use it that way, it becomes much more valuable. Beyond watching just two moving averages, traders sometimes use a ribbon to see the structure of a trend more clearly. A moving average ribbon is simply a group of averages with different look-back periods layered on the same chart. The shorter lines react quickly to price, and the longer lines respond more slowly. What matters is not one line by itself, but the shape of the whole group. When the ribbon is orderly, sloping together, and well spaced, it can reveal strong trend conditions. In that sense, a ribbon gives you a broader visual read on trend quality, not just one crossover event. Most traders build a ribbon with evenly spaced settings, so the structure is easy to interpret at a glance. You can use at least 3 moving averages, but 5 lines is a very common setup. For example, a daily ribbon might include the 10, 20, 30, 40, and 50 period averages. Consistency also matters. It is usually better to use all simple moving averages or all exponential moving averages rather than mixing them together. The goal is to create a clean visual sequence that shows how short, medium, and slightly longer trends relate to one another. When reading a ribbon, the most important things to study are slope and spacing. First, ask whether the lines are generally sloping up, down, or flattening out. Then look at whether the lines are spreading apart or compressing closer together. Wider spacing often suggests stronger alignment across time frames, while compression can hint that momentum is fading. It is also useful to notice when the shortest average starts moving back through the ribbon, because that can signal a broader shift in behavior. The key is to read the whole structure rather than overreacting to one isolated cross. An expanding ribbon usually suggests trend strength is increasing. In an uptrend, the faster averages stay above the slower ones, and the spacing between them widens as momentum builds. In a downtrend, the same idea applies in reverse, with the faster averages staying below the slower ones. That orderly, fanning appearance tells you multiple look-back periods are starting to agree with each other. For swing traders, that can be a helpful sign that the move has real directional force behind it. It is still not a guarantee a trend will last, but it does show stronger alignment than a compressed ribbon would. A contracting ribbon sends a different message. When the lines begin moving closer together, the current trend may be losing energy. That does not automatically mean a reversal is coming, but it often means the market is pausing, consolidating, or becoming less decisive. This is why contraction should be treated as a warning rather than a prediction. Price action still needs to confirm whether the chart will pause and continue, or actually turn. In practice, a narrowing ribbon tells you to become more attentive to what price does next. A tangled ribbon is often the clearest warning sign of all. When the lines are flat, overlapping, and repeatedly crossing, the market is usually drifting sideways or moving through a transition without clear direction. Trend-following trades often perform poorly in that kind of environment because there is no strong structure for the averages to reflect. Instead of giving clean support or resistance, the lines just twist around each other. In those conditions, patience often has more edge than action. A tangled ribbon is less a signal to trade and more a signal to wait. The ribbon becomes much more useful when you follow its development over time. Imagine 1 month where the ribbon is flat and tight while price moves in a range. In the next month, the lines begin turning up and fanning out as trend strength improves. Then, in a third month, the ribbon starts narrowing again as momentum fades. That sequence tells a much richer story than any single snapshot could. It reminds you that trend quality changes gradually, and the progression often matters more than one crossover inside the ribbon. There are a few common mistakes that make ribbons less useful. One is using too few averages, which reduces the value of seeing structure across multiple time windows. Another is applying ribbons on very short time frames where noise overwhelms the pattern. Traders also get into trouble by assuming contraction guarantees or reversal, or by reacting too strongly to one small crossover inside a larger ribbon. Just as important, the ribbon should never replace price action around key support and resistance levels. It works best as a supporting trend tool, not as a standalone signal machine. A simple practice exercise can train your eye quickly. Open a daily chart for a stock like Apple or Microsoft and add the 10, 20, 30, 40, and 50-day averages. Then look for one period where the ribbon clearly expanded, one where it contracted, and one where it contangled. For each case, note what price did afterward. Did expansion lead to steady follow-through? Did contraction lead to a pause? And did tangling lead to choppy movement? That kind of visual repetition helps you learn to recognize ribbon structure in real time. The main takeaway is that a moving average ribbon helps you judge both direction and quality of trend. Expansion suggests stronger trend conditions because multiple averages are aligning and separating. Contraction warns that momentum may be fading even if the trend has not fully reversed. Tangling often signals a lower quality environment that many trend traders prefer to avoid. Most importantly, the ribbon should be read alongside price action rather than by itself. When used that way, it becomes a very practical visual tool. Moving averages become more useful when you combine them with the horizontal price levels traders already care about. Support and resistance come from prior swing highs, swing lows, and breakout zones, so they give you fixed reference points on the chart. A moving average adds something different, a dynamic reference point that shifts as time passes and new prices come in. When both tools are used together, they can frame pullbacks and reactions much more clearly. For example, a pullback into a rising average means more when it happens near an old support zone. That combination often gives a swing trade better location and clearer structure. A moving average can act like dynamic support or resistance, but only in the right context. In an uptrend, a rising average may serve as an area where pullbacks attract buyers. In a downtrend, a falling average may act as a zone where rallies meet sellers. The slope matters because it tells you whether the average is supporting direction or simply drifting sideways. The broader trend matters too because a moving average in a strong trend behaves differently than one in a range. So the average is not magic. It works best when traders are already seeing the same directional message in price. Dynamic levels usually become stronger when they line up with horizontal structure from earlier price action. A horizontal level shows where the market has already reacted in the past, while a moving average reflects current trend-based interest. When those two features overlap, more traders tend to notice that area. This kind of overlap is often called confluence. For a swing trader, confluence can improve trade structure by creating a more logical entry zone and a more sensible area for risk placement. In many cases, the best setups come from that agreement rather than from the moving average alone. The moving average you choose should match the kind of trade you are trying to take. Faster averages, like the 9 or 21 EMA, are more useful for short-term swings because they respond quickly to price. The 50 SMA often works well as an intermediate trend guide, especially for pullbacks in established moves. The 200 SMA is much slower and is better viewed as a major long-term level rather than a short-term trigger. If you use an average that is too fast, you may get noise. If you use one that is too slow, you may get a signal that arrives after the opportunity is already gone. A practical setup starts with a checklist rather than with a single touch of the average. First, identify the trend by looking at the slope of the average and where price sits relative to it. Then wait for price to pull back toward the average instead of chasing an already extended move. After that, look for a real reaction, not just contact. Nearby horizontal support or resistance gives the touch more meaning and can help define the trade. Before entering, the final step is to define risk and target so the setup makes sense from a reward to risk standpoint. What makes the setup meaningful is not the touch itself, but the behavior around it. In an uptrend, a bullish candle after price tests the average can show that buyers are actually stepping in. In a downtrend, a bearish reversal after a test can show that sellers are still in control. Sometimes a doji or pause candle is enough if the next candle confirms the reversal. Other tools like volume, momentum, or RSI can strengthen the read if they support the reaction. The larger point is that response matters more than contact. A moving average is only useful if price respects it in a visible way. Consider a stock that rises from 90 to 110 in a clear uptrend. Its 50-day simple moving average is rising near 100, and price pulls back to test that area before closing back at $102.50. That close matters because it shows the market did more than just touch support. It reacted positively from it. If volume is also 40% above its 20-day average, that gives the bounce more credibility. A trader might enter at 102.50, place a stop around 99.50, and target the next resistance near 113. In that example, the trade works because trend, support, moving average, and volume all line up together. This method becomes less reliable when the market is not directional. In sideways conditions, moving averages often flatten out and lose much of their value as support or resistance. Price can drift above and below them repeatedly without producing a meaningful move. Repeated crosses without follow-through are a warning that the market is noisy rather than trending. Low volatility chop can be especially deceptive because it feels calm while still producing weak signals. In those environments, the edge from combining averages with levels fades quickly. Most mistakes here come from forcing trades before the market has earned them. Buying the first touch of an average without any confirmation is a common problem. Trading against the slope of the average is another, because it ignores the direction of the trend itself. Traders also make poor decisions when they overlook nearby highs, lows, or breakout zones that could block the move. Weak bounces on low volume and stops placed too tightly around normal noise can turn decent ideas into bad trades. The better approach is to wait for alignment between trend, level, reaction, and realistic risk placement. A quick chart review can help you judge whether a bounce setup is worth taking. Start by finding pullbacks to the 50 SMA in an established uptrend. Measure the range of the bounce bar by comparing its high and low, then compare that with the stock's recent average daily range. Mark the nearest prior high as a possible target and the bounce low as a risk reference. From there, ask whether the reward is at least twice the risk. This process keeps the setup practical by tying the chart pattern to measurable trade structure. The big idea is that moving averages work best inside a broader decision framework. They are more useful in clear trends than in messy ones, and they are more useful when they slope with the trade direction. A decisive price reaction matters more than a casual touch. Volume or momentum confirmation can help separate a strong bounce from a weak one, and horizontal support or resistance should shape where you place stops and targets. When averages are treated as context instead of standalone signals, they become much more effective. A whipsaw is what happens when a crossover gives a convincing signal and then quickly fails. Price may break one way, trigger an entry, and then reverse before a real trend ever develops. For swing traders, that usually means a small loss or a stop out caused by back and forth movement rather than by a true directional move. Crossovers are especially vulnerable to this in sideways markets. The moving averages still cross, but the market itself has no trend to support the signal. So the chart looks active, while the trade has very little edge. Ranging markets create false crossovers because price is bouncing between support and resistance instead of building a sustained trend. In that environment, directional bias is weak or missing altogether. The moving averages flatten out, drift toward the middle of the range, and cross each other often. Those repeated crosses can look like opportunities, but they rarely lead to durable moves because price is still trapped within the same boundaries. This is one of the most important context checks in swing trading. A trend-following tool becomes much less reliable when the market is not trending. Before acting on a crossover, it helps to ask whether the chart is really trending or simply rotating inside a range. If support has held multiple pullbacks and resistance has capped multiple rallies, price may just be oscillating between familiar levels. That means the market is moving, but not progressing. Longer moving averages often give this away because they start to look flat or tangled instead of clearly sloping. A crossover that appears inside that kind of structure deserves caution. In many cases, the warning signs of a range are visible before the signal even appears. One simple filter is to check the slope of the longer average before trusting a crossover. For bullish trades, a rising longer average suggests there is at least some underlying upward pressure. For bearish trades, a falling longer average suggests the opposite. But if the longer average is flat, the crossover becomes much less meaningful because there is little broader trend behind it. This does not guarantee success, but it helps separate possible trend starts from low-quality range signals. Slope gives context that the crossover alone cannot provide. The second filter is to require price to break out of a recent channel. Instead of buying a bullish crossover in the middle of a range, you can require price to move above the recent 20-period high. Instead of selling a bearish crossover in the middle of the range, you can require price to break below the 20-period low. This keeps you from acting on signals that happen inside the no man's land of sideways movement. The idea is simple. The crossover gets stronger when price also proves it can leave the range. Without that breakout, the signal often has nowhere to go. A third filter is to confirm the setup on one higher time frame. A smaller chart can look energetic and full of opportunity, while the larger chart is still trapped in a range. For example, an hourly chart may flash a bullish crossover, but the daily chart may show price boxed between major support and resistance. In that case, the larger structure often limits how far the smaller move can travel. This is why many traders check one time frame above their trading chart before acting. If the higher time frame is also ranging, caution usually makes sense. Sometimes the best trading decision is simply to do nothing. If price is trapped between support and resistance, the longer average is flat, and the higher time frame is also sideways, there may be no real trend edge to exploit. Taking every crossover in that environment often means feeding whipsaws rather than finding opportunity. Patience is not passive here, it is a strategic choice. By waiting for a breakout and better structure, you give the crossover a chance to work in the kind of market it was designed for. Standing aside can be a high-quality decision. Imagine a stock trading between 100 and 105 for 3 weeks, while the 9 EMA and 21 EMA cross several times. A bullish signal near 103 fails because price cannot break above the top of the range. Later, a bearish signal near 101 also fails because price still cannot break below support. Meanwhile, the 21 EMA stays nearly flat, which tells you the broader short-term trend is weak. The important point is that the crossovers are happening, but the market is not leaving the box. That is exactly the kind of environment where filters can save you from low-quality trades. When the range finally ends, the same crossover idea becomes much more useful. Suppose price breaks above 105, the 21 EMA starts sloping upward, and then a fresh bullish 9 and 21 EMA crossover appears near 106. This time the signal is no longer trapped inside the old range. Price, trend structure, and moving average behavior are improving together. If the move then advances toward 110, the difference is easy to see. The crossover is now working with breakout conditions instead of fighting them. Filters do not create certainty, but they do help shift attention toward stronger setups. A good practice exercise is to review a real 30-minute chart and mark the support and resistance of a sideways range. Then count how many 9 and 21 EMA crossovers occurred inside that range. After that, ask how many of those signals would have been filtered out by a flat slope rule or by checking the higher time frame. This builds judgment about when a crossover deserves trust and when it should be ignored. At the same time, be careful not to overfilter so much that no trade ever qualifies. The goal is better selection, not perfection.